Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden secrets behind corporate filings. Sometimes there is a lot more than meets the eye in those dry documents. Like today's report from Fifth Third BANCORP, where a seemingly simple act signals a much bigger move. Today we are diving into a Form 8K filed by Fifth Third BANCORP on the 13th of January 2026. Now remember, these reports are filed when companies have big news to share, and this one is all about a specific financial maneuver. Forget the fluff, the jargon, the endless pages of disclosures. We are cutting straight to the executive summary, the main event. So what is this all about? Well, Fifth Third BANCORP is basically tidying up its balance sheet by calling back some debt. The core of this report is the announcement that Fifth Third Bank, the bank's wholly owned subsidiary, is redeeming all of its outstanding 3.850% subordinated notes. These notes were originally issued back in March of 2016 and were set to mature on the 15th of March 2026. The redemption date here is the 13th of February 2026, which means they are calling these notes back a little bit earlier than planned. Think of it like paying off a loan before its due date to save on interest. So why did this is called an optional redemption, and it usually happens when a company believes it can refinance this debt at a lower interest rate or when it has enough cash on hand and wants to simplify its financial structure. The report spells out that the total amount being redeemed is the $750 million principal plus any interest that is accumulated up to but not including the redemption date. This means all of these specific notes will be gone, effectively wiping them off the books. Now, while this redemption itself is straightforward, the broader financial health of Fifth Third BANCORP is always worth a look, especially given the current economic climate. We saw several types of preferred stock listed, like the depository shares representing a 1/1000th ownership interest in a share of 6.625 fixed to floating rate, non. Cumulative Perpetual Preferred Stock Series I. This means Fifth Third has various classes of preferred stock outstanding, meaning they have different types of shares that pay dividends at different rates. This is pretty standard for large financial institutions, as preferred stock can be a way to raise capital without diluting common stock ownership. Their common stock is traded under the ticker symbol FITBEEB on the Nasdaq Stock Market LLC. This is the core equity of the company, and its performance is what most investors watch closely. While this specific filing isn't a deep dive into their quarterly earnings, we can infer some things from their actions. The report includes a significant section on forward-looking statements. This is essentially a legal disclaimer warning investors that the company cannot guarantee future results and that many factors can impact their performance. They list a whole host of potential risks and uncertainties. Some of these risks are pretty standard for a bank, like deteriorating credit quality, loan concentration by location or industry, and problems encountered by other financial institutions. But they also mention more modern concerns like cybersecurity risks, failures by third party service providers, and the inability to implement technology system enhancements, including the use of artificial intelligence. This highlights the constant evolving landscape of the banking industry and the challenges companies face in staying competitive and secure. One of the most significant risk factors mentioned here is their pending merger with Comerica Incorporated. This is a huge deal for Fifth Third BANCORP, and the report acknowledges the risks involved, such as not realizing the anticipated benefits of the merger or a delay in closing. Mergers are complex and can present both massive opportunities and significant hurdles. The success of this merger will likely be a major story for Fifth Third in the coming years. The fact that they are actively managing their debt, like redeeming these subordinated notes while also navigating a major merger, suggests a proactive approach to financial management. They are trying to optimize their capital structure and reduce costs even. As they prepare for such a significant integration, they also have other preferred stock series listed, like the depository shares representing a 1/40th ownership interest in a share of 6.00 non-cumulative perpetual Class B preferred stock series A, which indicates a diversified approach to raising capital. The press release announcing this redemption is attached as Exhibit 99.1. This is where the company would have provided a more formal announcement to the public. And at the end of the report, we have the signature of Brennan Willingham, Senior Vice President and Treasurer, showing that key financial officers are signing off on this disclosure. So let's break down what this all means. Fifth Third BANCORP is making a smart move by redeeming these subordinated notes. It is a sign of financial strength and confidence in their ability to manage their debt effectively. Paying off higher interest debt early can save millions in the long run, and it simplifies their financial obligations. This is especially important as they gear up for the massive integration of Comerica. The risks they've outlined are extensive, but again, many are standard for the industry. The big unknown is how smoothly the Comerica merger will go. If they can successfully integrate Comerica and achieve the expected synergies, it could propel Fifth Third BANCORP to a new level. However, if there are significant hiccups or delays, it could weigh on their performance. Looking at the preferred stock listings, it shows Fifth Third is utilizing various financial instruments to fund its operations and growth, which is a common strategy for large banks. The key will be how well they manage these different capital sources and their associated costs. In conclusion, Fifth Third Bancorp is playing smart by strengthening its financial foundation. The redemption of these notes is a positive signal indicating a focus on efficiency and cost reduction, which is crucial, especially with a major merger on the horizon. The success of the Comerica integration will be the ultimate test for the company's strategic direction. We should keep a close eye on their future earnings reports and any updates on the merger progress to really gauge their long-term trajectory. Alright, that is our quick decode of this Fifth Third Bancorp filing. What is your take on this debt redemption and the pending merger? Do you think it is a smart move, or are you concerned about the risks involved? Let us know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more insights. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you in the next decode.